and our participants. We would like to begin with this session now. So we are all here today for the session on financial arrangements and disaster risk reduction with a focus on 15 Finance Commission and insurance. As most of us know, in the aftermath of natural disasters, financial aid is offered in accordance with relief programs, and the Fifth Finance Commission has constituted new recommendations for disaster response, which are in accordance with the DM Act of 2005. This session aims to highlight the role of financial arrangements in disaster risk reduction and the 15 Finance Commission and insurance. For this, we have a panel of very eminent people with us today. But for further overview of the session and our panelists, I'm going to hand this over to Dr. Anuradha Maurya, who's the junior consultant with NIDM. Over to you, Dr. Anuradha.
Thank you, Ms. Valeri. A very good afternoon to all the distinguished delegates and participants. I, on behalf of National Institute of Disaster Management, cordially welcome you to today's webinar, which we have in collaboration with the Sphere India COVID-19 Academy. I'd like to convey my regards and welcome all our esteemed delegates for the day. We cordially welcome Major General Manoj Kumar Bindal, PSM, who's the Executive Director of NIDM. He will be joining shortly, and Professor Santosh Kumar, who is the head of GIDRR and DRR division of NIDM. He will be giving us the keynote address and is also one of the main panelists for the day. Our two distinguished panelists, Dr. Pratap Rana, who is the Associate Professor of National Institute of Public Finance and Policy, and Mr. Deepak Malik, who is the Operations Specialist at the World Bank. We welcome you all and extend our gratitude who, despite their busy schedules, made time to grace this webinar. I also welcome all the coordinators from NIDM and Sphere India and all the participants for attending today's webinar. And I further convey my warm wishes again on behalf of NIDM and Sphere India. So I think without further ado, we should just start with our scheduled plan.
Thank you, Dr. Anuradha. First of all, I would like to welcome for our keynote address, Professor Santosh Kumar. Professor Santosh Kumar is a professor at NIDM, and he's a disaster risk reduction, policy planning, and capacity development expert with 25 years of experience in different positions in the development planning and DRR sector. A PhD in economics, he studied gender and development at IDS Sussex, UK, and received professional training in DRR from Israel, backed with international work exposure at the World Bank and intergovernmental body of SAA-RC. He has an experienced hand in designing, planning, and implementing mitigation and long-term disaster recovery plans and projects. With that, Professor Santosh Kumar, I would please welcome you for the keynote address.
Thank you very much, Valeri and Dr. Anuradha Maurya, and all the distinguished panelists, Major General Manoj Kumar Bindal, who would like to join, would be joining very shortly, and Mr. Deepak Malik, and also Mr. Jaishankar. And then we have our distinguished delegates from different parts of the country who have joined today. Along with Pratap Rana from the National Institute of Public Finance and Policy, who is our keynote. He's a key speaker on financing, and also Deepak Malik, who would be giving the perspective of the World Bank. I would like to keep a kind of a perspective in terms of that how financing has been seen in disaster risk management in the country. And prior to the 15th Finance Commission, disaster funding has always been a challenge other than kind of post-disaster response and relief. Since when the disaster risk management was with the Ministry of Agriculture way back before 2002, and when the whole of rule of business got transferred to Ministry of Home Affairs. During that time, we had several finance commissions also, and then until 15th finance commissions, we had 14 finance commission. So all those have this deliberations on the starting from the margin money scheme to CRF, Calamity Relief Fund, then to National Disaster Response Fund, and now we are talking about National Disaster Response and Mitigation Fund. But for the larger information to the audience who have joined today, this has been debated for long, and in the 2005 Act also, National Disaster Management Act, it was mentioned that creation of mitigation fund, and that creation of mitigation fund never took place at the national level and also in many of the states. But Uttarakhand was one state which came up with the allocation of disaster mitigation fund as a kind of initial thing, and then subsequently to one or two more states. But as a whole of Pan-India Finance Commission recommendation, this is the first time which has happened. And this deliberation, which took place, longer deliberations, a lot of consultancy took place with the different expert groups and all. And finally, like NDMA, Ministry of Home Affairs, DM Division, and also that Finance Commission consulted, where the NIDM was also part of the deliberations. So in this deliberation, this 15th Finance Commission came, and then talking about that how disaster management should be financed in India. And there 3-4 provisions have been made, and I'm sure as Mr. Pratap Rana is there, Mr. Jaina is there, and he would be deliberating in detail about this Finance Commission recommendations and this. So I will not be touching on that. But when we see disaster risk management, the professionals who are working in disaster risk management, they always talked about DRR, DRR, DRR. And DRR means disaster risk reduction. That is an ex ante. And it was kind of a concept given not only in India, but also globally. It was appreciated and accepted in the Sendai framework. And it was believed that whatever we do as a kind of response, that will not be able to reduce the impact of disaster. So for reducing the impact of disaster, whether it's protecting lives of the people, number of affected persons with the disaster, and also the colossal damage to the property. If we are really intending to reduce these costs, we need to make investment ex ante. And ex ante investment, when we talk about, then is only two portfolio which we had earlier prior to this 15th Finance Commission. One which we had as a kind of a mainstreaming DRR, which we were talking about, that each of the ministry and department of Government of India should start allocating in terms of that how much 30% of the money should be kept in the form of disaster risk management. Meaning thereby, if any sector, say power sector or the health sector, if they are making a new project, they have to see that how their risk profile of those projects, and even if the stock which they had in the capital format, they should look at that and start seeing the exposure of the stock, and then addressing with their own money allocation, which subsequently called as a Flexi Fund with the Government of India's nomenclature of financing. So Flexi Fund was there, and then but it never got utilized by the departments in terms of reducing the risk. So so the debate kept on kept pursuing in the country when we were discussing about that we should have a financing system which can address the ex ante disaster risk management. Whatever we may do, we have created National Disaster Response Force. We have created National Disaster Response and Relief Fund. But still that impact is very high when it comes to disaster. India is currently debating upon that how much money is to be paid to the deceased of COVID-19, whether it will be depicted in the disaster management and so on and so forth. But this is all post-disaster response. It's not that ex ante, it's all ex post. So there is a huge transition took place in the 15th Finance Commission, and which we say that is a kind of a, I always say in terms of financing, is a kind of a renaissance for financing DRR in terms of allocation ex ante in the budgetary allocation, And that is going down for everything, like go for mitigation projects, then you go for kind of a capacity building, then you also go for the demonstrative projects for risk reduction, and so on and so forth. So the idea was to actually collate those learning and see this demonstrate that when the risk is identified and ex ante actions are taken, and how that is helping in risk reduction and reducing the impact when it comes to disaster. So this is the thing which we are discussing, and how we are seeing insurance also as an option, where the Finance Commission has also outlined that how we can see the risk transfer mechanism as an option of disaster management financing. And India, which we had many of the agriculture insurance is there, but say earthquake insurance and or any other catastrophic insurance, cat bond, and other these financial tools are still to be looked into. Some other tools are also there for monetary policy and fiscal policy are there. Fiscal policy normally we use for budgetary provisions, where we go for kind of taxation policy and so on and so forth. And that is what we say that at the time of disaster, we keep some cess is there and all. These are the financing tools. And monetary policy also, that it was utilized very much in the COVID-19 by several differential rate of interest, then moratorium on the interest rate of the people who have taken EMI. And so the idea was to ease the pressure on the people who are getting affected by disasters. So again, this is a kind of a philosophy of the welfare state, that how we can bring in those financial tools, which is actually disaster was seen mostly as a kind of a post-disaster phenomena, and we, as per the financial tools. But now when the time has changed, the impact is changing, climate change is there, and we are seeing that large number of disasters likely to happen with the higher intensity because of the climate change. So we need to look at that how in this kind of a context, insurance can also find insurance. NIDM has submitted its working group reports in the on insurance to the government of India, and where all this most of the CEOs of the insurance and reinsurance companies of the world, they were there as part of this initiative, and many of the states participated in that, and my states are looking forward to how to go for insurance as a risk transfer options from there as a financial budget. So only this much I had to say today, and I would stop here, but I'm very much happy to see the galaxy of resource persons, especially representing National Institute of Public Finance and Policy and the World Bank, the multilateral organization. They will give insight on that how ex-ante funding can be propagated, and insurance can also be seen as an option of funding disaster risk management. So once again, I take this opportunity to welcome Major General Manoj Kumar Bindal, the Executive Director of NIDM, Mr. Deepak from the World Bank, and also Dr. Pradeep Ranjan Jaina from National Institute of Public Finance and Policy, and Villari from Sphere, Dr. Anuradha from NIDM, and all the distinguished participants who have joined. I'm sure that this deliberation would be very, very useful in contextualizing the current situation in India of COVID-19, and also the disaster financing in the context of climate change, and then also new disaster challenges which are emerging as ex ante. I'm not saying exposed. Exposed, we have a very robust system, but we need to look at that ex ante initiatives. So I would stop here, and thank you very much for giving me this opportunity. Thank you, Dr. Anuradha, for calling me, and now over to you, Villari and Dr. Anuradha. Please go ahead.
Thank you, Professor Santosh, for that very comprehensive overview about financial arrangements in DRR and also what we will be covering today. I am very pleased to announce that we have Major General M.K. Bindal with us, who is the Executive Director of National Institute of Disaster Management. He was commissioned into the Corps of Army Air Defense in December 1985. An alumnus of the National Defense Academy, Major General Bindal is a graduate of the Defense Services Staff College and has attended the prestigious Higher Command course at Army War College, besides excelling in all other courses in the Army. He has an academic background of defense and strategic studies and defense and management studies, During his more than 3 decades of service, he has held important command and staff assignments. With that introduction, it is an honor to welcome you, sir, to please deliver the inaugural address for this session. Thank you.
Thank you, Dr. Valerie. Can you hear me?
Yes, sir, loud and clear.
Okay, thank you so much. And first of all, it's a great privilege to be here to be addressing this particular topic and with a fine array of panelists who will be talking to us. And I congratulate Professor Santosh Kumar and Sphere India for organizing this particular program. This is a program which is very close to the heart to NIDM because recently a publication was made by NIDM on disaster risk financing because that has been found to be a major gap in the uh, sustainable development goals, or we talk about uh, uh, alleviating the problems of the underprivileged in terms of the loss of livelihoods or loss of assets, loss of business, or to get them back on their feet. We have found that insurance can play a very, very big role. So disaster recovery in India is a big challenge. In most of the past disasters, in the absence of adequate resources, long-term recovery was not attempted. And Super Cyclone 99, Orissa, Gujarat earthquake of 2001, tsunami 2004, Kashmir earthquake 2005, and there are so many which are a good exceptions, but there are many others in which a lot of gaps exist. So, so the funds allocated by the 15th Finance Commission may now boost the recovery. Yet there is a huge funding gap between the available and the required funds for the long-term recovery. So recovery from a disaster can present many unexpected challenges. Those directly affecting financial recovery, such as delay in restoration, uh, then continuing operations and generating revenue, unexpected costs, and challenging insurance claims. So these and similar issues make it difficult to project the outcome of a catastrophe and manage the expectations within the organization. Financial preparedness creates a solid foundation for a more resilient, timely, and effective recovery process, and it also maximizes financial recovery through insurance and other resources or other sources, and in doing so minimizes the economic loss. So we can say that it can mean the difference between significant financial loss and sustainable recovery. So critics of disaster risk finance often argue that investing to avoid or reduce risk is more cost effective than investing in post disaster expenditures. So they also argue that insurance and other risk transfer instruments can be opaque and expensive, providing poor value to the governments. The two recent disasters of Kerala flood 2018 and Cyclone Foni of Orissa in 2019, uh, the memorandum generated by the two states at a tune of 26,000 crores and 28,000 crores INR respectively. So these losses and subsequent dovetailing of development funds to support the disaster recovery and rehabilitation, it results in the states failing to achieve the desired growth rate and thus creating the growth gap. So look at the 9 years data on the gap between economic losses and funds available with the states through SDRF and state development funds. One can clearly observe that the huge gap which is underlying the immediate need for developing alternate risk transfer mechanisms like insurance driven NatCat programs is a necessity. It is a necessity. I'll just give you an example that many countries in the world have gone in for disaster risk insurance. I'll give you just two examples of successful insurance driven disaster management programs. One of them is Southeast Asian Disaster Risk Insurance Facility, SCADRIF. It is in December 2018 that Cambodia, Indonesia, Laos, PDR, Myanmar, Singapore, and Japan, they agreed to establish SCDRIF as a trust to own a general insurance company in Singapore. The first financial solution developed by them is a regional catastrophic risk pool, especially for flood risks developed by and for Cambodia, Laos, and Myanmar. And the product uses river gauge data, station data, modeled gauge station data, and remote sensing data to determine the footprints of the events. So the parametric trigger is assessed using the aggregate value of the people affected over a 21-day window. And it is now also planning to provide financial solutions to other middle income ASEAN countries such as Indonesia, which are now developing or enhancing insurance arrangements for public assets. The second successful example is the CCRIF, Caribbean Catastrophe Risk Insurance Facility. It is a segregated portfolio company, SPC, registered in the Cayman Islands, operating as a virtual organization supported by a network of service providers and currently owned by its 19 member countries in the Caribbean. And since 2007, CCRIF offers parametric insurance products protecting member countries against loss stemming from hurricanes, that is, tropical cyclones, and earthquakes. And since 2013, the offering has been complemented by excess rainfall cover. Recently, in 2019, they introduced a coverage for the fishery sector also in two of the member countries with support from the World Bank and the US State Department. And October 20, they introduced coverage for electrical utilities, covering power grid and transformation systems, generally understood as uninsurable risks. So the payouts have been to the tune of more than 160 million US dollars. So large insurers like Munich Re and others are supporting such programs since its inception. So we have seen that governments across the world have created these insurance-driven programs to address varied needs depending on the priority and the requirements. And a very large set of schemes are driven by the need for social protection for the vulnerable section of the society. The schemes not only support the asset and livelihood protection of for the low income group, these also act as ex ante disaster risk financing tool, which Professor Santosh Kumar was referring to, enabling government to act swiftly and deploy funds for protection and rehabilitation, thereby reducing the human and economic losses and subsequently lowering the burden on the state exchequer. So, a sovereign risk management framework can be used to decide on the priority and target segment to be covered under the program. So there is what why I gave these examples is there is a need uh, to start this process in our country so that risk transfer can take place and the needs of the low income group, the marginalized section, BPL, the small industries can be met so that they can get back on their feet faster and they can start their new life after a disaster in a much better way than what they are doing today. So with this, I will finish because I'm keen to hear to the esteemed panelists who will be coming after me. And thank you so much. And back to you, Dr. Valerie.
Thank you very much, Major General Bindal, for emphasizing on the fact that insurance can play a big role in disaster recovery and for highlighting the importance how the funds allocated in the 15 Finance Commission may boost recovery, delayed restoration, and continued operations. In continuing operations. With that, and it was interesting to know about the two examples that you mentioned about the Southeast Asian Disaster Risk Insurance Facility as well as the Caribbean Catastrophic Risk Insurance Facility. With that, I would now like to once again thank you and invite Professor Santosh Kumar to sort of emphasize on the various financial tools for disaster risk reduction. So over to you, Professor Santosh.
Yeah, just two things. One, the financial tools, when we are talking about, we should look into comprehensive engagement of those financial tools which are available. So one, that what Major General Manoj Kumar Bindal highlighted in terms of that the two examples of the tools, and then many of the people are risk pooling, many sovereign pooling of this resources, but that has a complexities in terms of using that as in a kind of a sovereign risk pooling. Many countries have done, Caribbean has done, and this is also now, and World Bank is facilitating all these processes. Especially now we are talking as earlier it was a big problem in payout, but now payout has been sorted out with the parametric, and people are learning also and evolving. So one that we are seeing this as the tool which we are using, just not as insurance, one as it, this is one of the tools is insurance, and within the insurance there are several tools. So that to be taken into account. The second important thing is that what we talk about that ex ante funding for mitigation, that is also financing. So how we can go for risk reduction with the demonstrative project with the engagement of Finance Commission's recommendation. The third important thing which we in the financial tools which I would like to bring into micro insurance and other thing which also come. The fourth insurance financial tools would be, which I was telling that in terms of loan is also a kind of a funding mechanism, the multilateral and the bilateral. When what General Bindal highlighted that most of the recovery program is not picking up, like 26,000 crores of Kerala flood, then also the two subsequent floods, and also Orissa flood, Cyclone Fani, that was also almost 24,000 crores of recovery. So no institution which are there to support this 24,000 crores of recovery funding. So from where these institutions or the government can bring those funding. So that dovetailing is one of the options, is also one of the funding tools. Then secondly, go for the multilateral, bilateral support. That comes under as a kind of a later stage, but before that, any government would like to exhaust that any thing which is coming as in the form of grant. And Indian policy of seeking grant is different, that we will not, as Government of India's policy is not to ask for any support or grant financial from the outside India or external agencies. But it is when but the other countries then where they are offering, India is not saying no to that. This is also one of the financing mechanism as a kind of a grant format. Then what we say that if everything gets exhausted, then you can think of going for a multilateral kind of a loan, whether it's an IBRD loan, if there is going for investment, or there we are going for any other financial tool for this recovery program, soft loan. So that is also funding gap will always be there. Like 26,000 crore will never be covered with the 26,000 crore. But government also go for the taxation. Taxation is another funding source. So cess, say petrol, government is putting cess on that. And post-recovery in Gujarat also happened different kind of a cess put in by the state government, where the state center process is there. And then coming to then the monitoring, which said that monetary tools are also there, where you kind of reduce at time the interest rate of the bank and also enhance the bank. So that is operational by the RBI and with the government policy. So what I'm saying is should be financing when we are talking about disaster risk financing for ex ante to disaster response to the long-term recovery and rehabilitation. It should be seen in comprehensive format, and there whatever the Finance Commission has given should not be seen as a kind of a only as a last option, but whatever has been recommended to be utilized optimally. And then second is also that we can use that other funding sources which are available in India and also across the globe. And that is why India is also part of these agencies. They are the member of the institutions, whether it's come to ADB, World Bank, or Development Bank, New Development Bank, or any other. So that is also a funding source, but that depends on the state government, how much they are comfortable with in bridging those funding gap and where they wish to fund. But ultimately, Government of India has to see if these two funding, that multilateral loans are there, then Government of India and Department of Economic Affairs have to see with the state government compatibility and the requirement, the need, and so on and so forth. But of course, it has to be seen in kind of a very, very comprehensively, rather than just looking at one tool and then other tools we are forgetting. So comprehensively, we should be seeing this, all these tools which are available, how best we can utilize optimally for the welfare of the society. Thank you.
Thank you, Professor Santosh, for emphasizing. And I actually took note of 6 major tools that you mentioned to us, and you mentioned that within insurance also there are other tools that we can look at, and whether it is micro insurance or grant. And while we don't ask for grants, we do accept it if it is offered. And please correct me if I'm wrong. And also the possibility of loans, whether multilateral, bilateral, or soft in nature. And taxation also can be one of the important disaster risk financing tools. However, the most important thing to emphasize on here would be that these need to be seen comprehensively and not as separate from the 15 Finance Commission recommendations. With that, I would now like to welcome Mr. Pratap Rana, who would be speaking on the recent Finance Commission recommendations for disaster risk management. He is the Associate Professor at National Institute of Public Finance and Policy. He works on subnational public finance, public financial management, and fiscal decentralization. He has helped a number of state governments in India in preparing medium-term fiscal plans under the Fiscal Responsibility and Budget Management Acts. He coordinates training on public finance management for central and state government officials at NIPFP and abroad. I welcome you, Professor Pratap, for your address. Thank you.
Thank you. Am I audible?
Loud and clear, sir.
Yeah. Thank you, NIDM, for inviting me to this very important discussion. Thank you, Major General Bindal Saab, Professor Santosh Kumar, and all other Dr. Moria, Dr. Agarwal, and all other faculty members, those who are associated with this. You know, I am from Odisha actually. You know, I was there in 1999 super cyclone. You know, and people, those who see disaster as a distant event in TV and other things, they need to realize the kind of fear, despair, the destruction that this kind of disasters bring to the lives of people. Not only to the lives of the people, the loss to the government exchequer in terms of destruction of infrastructure is immense. And suppose a state like Odisha, with its limited resources, and for that matter, many other states who build the infrastructure with a lot of effort, it becomes very difficult to recover. And my second experience was with Bhuj, Gujarat earthquake 2001, when I was a member of an IPFP team to assess the financial loss and project the state finances and impact of that earthquake on the state finances. That was a different, that was our bread and butter. I'm not a risk management, disaster management expert. I'm a public financial management person. But looking at, that was my early exposure to these kind of big disasters. And what I found was, it was mostly, as other panelists have already said, it was relief and recovery, rescue, those kind of operations that this disaster brings in to immediate relief and rescue. It was actually, as I look at the literature, what and my next association with disaster was while preparing memorandum for the Finance Commission for Sikkim and a couple of other states, including Odisha. You know, there the state governments were, they continue to demand. They continue to demand to the Finance Commission that all the expenditures should be covered by the central government. The SDRF and NDRF should be financed by the central government, and there is a continuous demand to acknowledge various kinds of disasters as national disasters, various kinds of disasters to be included in this disaster financing. So those are the kind of demands they continue from the state governments, and it is also understandable as to given the financial needs, revenue, and spending demands of the state governments, they always look for financing from the central government. Now, this Disaster Management Act of 2005 actually brought certain changes in terms of institutions, in terms of building this National Disaster Management Authority, NDMA, and SDMA, and then the successive finance commissions, who although took incremental approach, but always made efforts and actually tried to strengthening the financial arrangement. If we go back to last 60 years, look at the calamity, when you start at the Calamity Relief Fund, then National Fund for Calamity Relief, and most recently, by starting from 11th Finance Commission to 14th Finance Commission, the SDRF and NDRF, and now, of course, the 15th Finance Commission, which included Mitigation Fund. So the Finance Commissions have always tried to strengthen the financial arrangements, but it also needs to be recognized as we deal with budgets, as we deal with state government finances. These schemes of funding, which is provided by the Finance Commission, continues to remain as the major source of funds for the state governments when a disaster strikes. So that is immediately they can actually get help from SDRF, demand more money from NDRF, and start asking for more money from the central government, the recovery and other things that waits. Everything said and done, the Finance Commission driven funding arrangement, the financing arrangement continues to be the major source for the state governments. Right. I also agree, and I agree with Bindal Sahib, Santosh Kumar, who strongly argued that we need to have innovations. We need to have innovations not only in financing, but also reviewing the risk and vulnerability, who are more prone to risk and vulnerability. That's what the 15th Finance Commission also argued. And to respond to that, improving our institutional policy capacity for disaster management, and what the other eminent panelists argue strongly, encouraging more stakeholders to participate. So those are the things we need, and we need to move a little away from the disaster relief only. Recovery and reconstruction are very important responsibility, and it becomes more so for the state governments in India who are fiscally weak. Now, if we look at the broader disaster risk financing, it is a joint effort, though there is a distribution of responsibility. But we need to recognize that primary responsibility lies with the state government, starting from organizing rescue, evacuation, and providing relief during and after the disaster strikes, and providing people assistance, and then of course the bigger responsibility of recovery and reconstruction. And union government plays a secondary role. It is kind of supplementary, provides personnel, provides NDRF people, provides army, provides other facilities during, and also helps the state governments in recovery process. Depending upon, there is always, as we in public finance, as we call it, a trade-off. There is always a trade-off for resources, and if you have more cloud, you get more. There's no denying of the fact in this. It is not true in India. It is true everywhere. It is true everywhere. Everywhere where there is a limited resources and requirements are very large. But in the process, what we understand that there is a bit of improvement. There is a quite bit of improvement in the process of early warning and preparedness by the state governments, and which has reduced the risk of risk to human life and mortality. If I compare to 99 Odisha cyclone, super cyclone, and the more recent Fani and other they continue. Every year there is a cyclone. And 99 there was nobody knew such a huge thing is coming. Thousands of people perished, and the destruction was devastating. The capital city didn't have a phone for the administration to organize the work. So we are moving ahead. We are moving ahead technically. We have moving ahead in terms of risk management. We are moving ahead in terms of disaster management. But so far as financing is concerned, there, as others pointed out, that area remains an area of concern. Now, if you look at the expenditures, let me have some data which I collected from the Finance Commission report. If we compare from 11-12, when the aggregate expenditure on disasters was something around 14,000-15,000 crores, which has increased something around 30,000 crores in 2018-19. But please remember, this is what has been spent from the whatever funding arrangements we have, whatever institutional arrangements we have, facilitated by the recommendations of the finance commissions. But the need, I believe, and everybody here also understands, is always more than what has been spent. Then the issue is when we look at the expenditures, the state governments continue to spend from their budget afterwards. The various departments, they continue to spend on repair, reconstruction activities. Not only the infrastructure departments, but education, health, everybody starts spending from their budget. And it depends if there is any special window, that is or special vehicle given by the central governments to those states who were affected severely by the disaster. So, in addition to the existing disaster management funding facility, the state governments and central government also spend from their budget. Now, this expenditure, this financing or expenditure on disaster, we need to look at from the point of view of disparity in our country in terms of interstate disparity, the capacity of states, the poverty, and their exposure to risk. That is another issue which Finance Commission pointed out, but that also should come to the discourse more prominently as to who are more prone and who has the capacity to manage this kind of thing. And we also, in public finances, we recognize this as a kind of contingent liability. There is a potential to happen in the future, which would put liability on the state governments. And this SDRF and NDRF as a source of financing, this is a kind of response, as it tells, it's a response fund. We generally do not reduce the risk. We do not reduce the contingent liability. The contingent liability continues to remain there for the state governments to manage in the future years. Now, means the issue that was pointed about the earlier speakers, given this high risk exposure and increasing contingent liability, we need to look at multiple instruments. Let us just go through the Finance Commission recommendations as to what are their approach. let us the four guiding principles of finance commissions. What are those four four guiding principles? Number one, that they recognized is the institutional structure like SDRF and NDRF has served its purpose well and given its legal status and operational utility. They recognize that this is a very this should continue as main vehicle for resources for the state. What they created is a kind of overarching institutional structure called disaster risk management fund by nesting some kind of mitigation fund in that. So SDRF and NDRF continues. Along with that, we have now mitigation fund within an overarching umbrella of National Disaster Risk Management Fund, NDRF, and State Disaster Risk Management Fund to better manage, prevent, to bring in preparedness and recovery and reconstruction activities into this. And the third principle, they continued with what is called the sharing principle, which was earlier 75-25 for general category states, 90-10 for northeastern and and Himalayan states, special category states earlier we used to call them. The 14th Finance Commission, in fact, actually recommended that it should be 90-10 for all. And that's what most of the state governments also continue to demand. And of course, northeastern and Himalayan states demand for 100%. That's a different matter altogether. So this 75-25% sharing principle continues, and Finance Commission stress for alternative sources of funding. So these are the four guiding principles. And now coming to National State Disaster Mitigation Fund. While I was preparing for the memorandum for Sikkim government, they continue, means for other states also. Mitigation has come up as an important demand from the state governments, basically demanding that if we take certain mitigation activity, if we try to take mitigation activities, it is going to reduce the risk. It is going to reduce the destruction later during the disaster. So taking cognizance of this need for mitigation fund, the Finance Commission has created this National Mitigation NDMF and SDMF within the overarching umbrella of SDRMF, right? And if you look at the Finance Commission report, the size and allocation of disaster risk management. What are the principles earlier? Earlier, it was mostly expenditure principle, expenditure-based approach to determine the allocation of funds for each state. But please try to get into this, that when, as I said, the state governments differ in their capacity, this expenditure-based approach actually states, they argue that it creates a kind of disparity, as better of states have much broader base, they could spend more, and that creates a disparity because it doesn't recognize the fiscal capacity of lower income states who couldn't actually spend, and the expenditure base are less. So that remained as a continuous argument between state governments and the finance commissions. So 15th Finance Commission tried to bring in a kind of new methodology where they used three instruments. One is capacity, which is reflected through expenditure, of course, and risk exposure, which are the areas and are more exposed to risk in terms of area and population, and they created a risk index, that is hazard and vulnerability index. So based on those three, the allocations have been made. And so when if you remember well, the 15th Finance Commission recommended a report for only 1 year, that is 2021. Then they recommended another 5-year report, 21-22 to 25-26. So in the 21-22 report, they increased the SDRF size to 28,000 crores, and according to them, this is a huge increase. And on that, they kept 2021, and they kept 21-22 SDRF amount at that level with a 5% increase for next 5 years. So it altogether, the SDRF size as recommended by 15th Finance Commission became 1,60,000 crores, 1,60,153 crores. Now, this is the catch. Means as I started saying, they created a mitigation fund at state and national level, but actually this is nested in this particular amount. When you have a total of 1,60,153 crores, out of this 80% is for SDRF and 20% for SDMF. Then once again, this SDRF, it has three components, which is response and relief 40%, recovery and reconstruction 30%, and preparedness and capacity building 10%. This is a general attitude of central committees who believe that they know best, and they don't give flexibility to the state governments like all other CSS. I'm not an this risk management specialist. I really do not know whether the state government, a particular state government, requires response and relief 40% of what has been allocated to them, and 30% for recovery and reconstruction, really, and preparedness and capacity building 10%. Yeah, I really do not know. But what when I look at other centrally sponsored schemes, yes, what I find is one size fit all. They do not give flexibility to the state to design and use the money the way they want. I really do not know, but I leave it to others to. But prima facie, it looks to me that there has been a kind of framework which the state governments have to abide by. Now, to the National Disaster Risk Management Fund, that is at the union level, the Finance Commission recommended something around 68,463 crores, and once again, for those 5 years, total 5 years, and once again, and that has also been divided into NDRF 80%, NDMF 80%, and the usual these three components of NDRF like response and relief, recovery, and preparedness, 40, 30, and 10%. So this is how the funding, the funding arrangement has been done under under SDRMF and NDRMF. And the Finance Commission actually tried within that to create a kind of diversifying funding windows. But once again, the whole, the aggregate amounts remain same. Within that, they tried to have something called recovery and reconstruction facility of 30%, and preparedness and capacity building grants 10%. This preparedness and capacity building, it recognized something around 6 types of activities, right? For NDRF, under NDRF, the expansion and modernization of fire service, resettlement and displacement of people affected by erosion. Those are the 2 things that was included in NDRF, so far as the capacity building is concerned. Then catalytic assistance to 12 most drought-prone states, managing seismic and landslide risks in 10 hill states, reducing the risk of urban flooding in 7 major populous cities, and mitigation measures to prevent erosion within NDMF. So these are the kind of 6 types of earmark allocations have been done which are included in preparedness and capacity building grants. Right? Finance Commission also discussed whether it is feasible to have district disaster response and mitigation plan, basically going to the grassroots level to be prepared, and empowering Panchayati Raj institutions for disaster preparedness and management. Do I have still 1 or 2 minutes?
Right, sir. If you could wrap it up into 3 minutes, please. Thank you.
Can I take 2 or 3 minutes?
Yes, sir. Yes, sir.
Yeah. Thank you. Okay. So the Finance Commission within its ambit, within the available resources, because Finance Commission decides sharing of resources with the state governments, and it keeps the financial ability of the central government given its expenditures and requirements of the state governments. So within its ambit, whatever resources it could muster for this particular purpose, it tried to bring in innovations, keeping the feelings, keeping the demands of the state governments. But always, as the state governments would always demand more, and they're also their demand also many times are need based. So, but what the 15th Finance Commission did, it brought several types of innovations into its financing framework. Now, it also recommended several institutional strengthening, capacity building measures which would prepare the state governments and union governments better for the risk management. And these include dedicated capacity within the Ministry of Home Affairs, basically to Ministry of Finance and NDMA, change in assessment process, and setting up a disaster database as a special initiative. Means we in this country we really do not have data on grassroots level events like Panchayati Raj. We do not have data on their finances. Similarly, we do not have much data on the disaster. So there is a need to have a very good disaster database, and people like us who are outsiders and work in public finance area, we look at actually data. We are not risk management experts to understand how these things will be organized unless and until we have a very good data to understand how the state governments are facing, what kind of risk and vulnerability state governments are facing, what are the laws and how they have managed in terms of budgetary and fiscal responses. Data is very important. And another very, very important public financial management principle that the Finance Commission recommended or suggested was to bring in outcome approach. Like means all departments should have their outcome approach. Means what they're doing, why they're demanding certain amount of budget, how they're spending, what are the outcomes, what are the outputs, what they have achieved, what are the performance indicators. Those needs to be there in every each and every spending. And similarly, the Finance Commission suggested to have some kind of outcome approach in this. So these are certain institutional strengthening capacity the Finance Commission has suggested. Now, coming to the most important thing that today we are discussing is alternative sources of funding, right? In alternative sources of funding, what was the Finance Commission's approach? It gave something around 5 or 6 alternative sources of funding ideas, suggestions. Let us see how those are going to be evolved. Number 1, state governments can issue reconstruction bonds with a 3-year maturity. It will be a kind of philanthropy for people who would like to contribute to this reconstruction bonds. Naturally, the interest rate will be less in this. So it will not be an investment option those who are looking at, but it would be a kind of extending a hand and joining in the efforts of the state governments in managing the risk. And and international financial institutions, contingent credit and standby facility, those who have repo with the international financial institutions like World Bank, ADB, IMF, and other things, where one could get financial help. Crowdfunding platform for disaster. This is a very very important thing. Crowdfunding, one could state governments could try to do crowdfunding. And corporate social and responsibility window. Once again, it depends what kind of corporate response would be there to the state governments which are rich, those who are poor, and given their office, given their activities in those states, to what extent corporate sector get into this field. And last but not the least is insurance. So I leave this insurance thing to the learn panel members to discuss a little more, and I stop here.
Thank you so much, Professor Pratap. I think that was a very detailed review on the recommendations that have been made by the 15th Finance Commission, and I'll take a while to sort of organize my thoughts in that. But in the meanwhile, I would like to invite Mr. Deepak Malik to speak on insurance penetration in India and the role of insurance in DRR and how it is beneficial in reducing disaster risk. Mr. Malik is a humanitarian and disaster risk management professional with over 2 decades of experience in emergency response, recovery, and disaster risk reduction. He has designed and managed over 50 projects on social development, emergency response, long-term recovery, and DRR. He has worked in Asia, Arab, Russia, and Africa region. He has an academic background of human rights and mechanical engineering and currently is serving as a consultant with the World Bank. With that, I would like to invite Mr. Deepak for his address. Thank you.
Thank you, Valerie. Thank you, first of all, to NIDM and Sphere India for inviting me for this important event. I think having a mitigation fund and the way Mr. Ranjan explained, that was very welcome. And I mean, I would have loved to hear from Mr. Ranjan long and long. I mean, that was very interesting. Thank you very much, sir, for that. I mean, to start with, I think my exposure in risk reduction started working under the leadership of Santosh Kumar ji. So he's also here. So thanks for that. I'm always thankful to him. To start with. Secondly, I think while we are talking about, I mean, since then, from those days, I see that, I mean, disasters are increasing, the intensity is increasing, the impact is increasing always. And there are predictions that catastrophic event about which we are yet not been very thoughtful, they are also going to increase, I mean, with environmental degradation and climate change. And every time what happens is that whenever there is such event, government always get into physical risks and I mean the budget volatility happens and government require large amount of money. And as explained by Bindal Saab also and Santosh Kumar ji also, that most of the time what happens is that governments deal with such situation by using their existing resources, reserve funds, or loans, or by increasing taxes on the people to recover that cost. And these all ex post models are, I mean, very well tested and still working very well in India. And it's a welcome news that, I mean, we in India are also starting to work on the ex ante measures like mitigation fund. Now, however, I mean, it was very interesting to see how it has been divided into 3 different parts for risk reduction, for capacity building, and for response. And would be happy to hear about that when the time occurs in coming 5-10 minutes. So, I mean, it was also very good to see that, I mean, we are also hearing from the government on bonds, reconstruction bond, like catastrophic bonds, which are, I mean, the business overall globally is increasing of these catastrophic bonds, and they are very good. I mean, mechanism for transfer of risk directly to capital market, and at least it doesn't put a lot of burden on the government, and you will be surprised to hear that, I mean, annually, I mean, catastrophic bonds business is increasing by $1 million per year almost, and definitely I think they are working very well, and I was happy to hear that government is also thinking of at least coming with some initial bonds on reconstruction bond in case a disaster occurs. Similarly, I mean, there are other things also like weather derivatives, I mean, which also talk about hedging of funds for climate risk, and should be considered while government think of expanding, as Dr. Santosh, Professor Santosh was saying that, I mean, we as India, big country, cannot depend on one tool or one instrument. Definitely, we should have a pool of instrument through which we should be responding. I mean, we should have financial tools also, financial mechanisms also should have. I mean, we should have varied things. So weather derivative is one of the things we should also be talking about. Like Binder Saab was talking about catastrophic pools, which have, I mean, Caribbean pool, and which Myanmar, Cambodia, Laos, PDR, which are, I mean, which are still exploring, or still coming up. I think such facilities should also can be a welcome uh, news if we hear something. India, given a big country, I mean, our states can also be considered as different entities, as country governments are coming together to create such facilities. In the same manner, India as a big country can think about bringing states to create such a facility. If anything is happening, I would be happy to hear on that. Uh, Apart from that, I mean, there are countries which are using catastrophic drawdown options, which is also a very common form of risk retention, and at least assuring that money is available at the time of disaster. And many countries have tried it, Philippines, Sri Lanka. And I recall when 2 years back, a flood occurred in Sri Lanka, and they immediately wanted money, and they already had that CAT DDO option, and they were able to get about $100 million immediately for response. So such options are also available, not only from the World Bank but from other multilateral institutions. I mean, India should also think about that. Uh, in terms of other sources of funding, I think which India is exploring is one is contingent funding, which is one of the source where from the multilateral bank, whenever there are projects, a zero component is kept in such projects, so that in case of a disaster, the money can be used from that contingent fund, taking away from any developmental activity which has been planned under the project. Uh, Contingent fund was used in India during even COVID this time, and I've seen, I've got many examples like in Uttarakhand and other disaster where contingent funds have been used from the ongoing projects of the World Bank, and there is such a thing with JICA also available. Now, I mean, what my understanding is that, I mean, as of now, India is not investing in pool insurances. It is not investing in bond as of now. But now, I mean, as I hear from Ranjan ji, that, I mean, reconstruction bonds are being thought of. So that's very good. uh, I mean, my understanding is probably that because India being a big country and we have central pool funds which can always be used, and at least it helps in risk retention. Uh, we are also not going ahead with the catastrophic insurance as of now, uh, probably because they are currently not very common globally, and second is the cost is very high with high uncertainty, and there are not many takers, and that is also one of the reasons that the costs are very high. Apart from that, I think in terms of public and private financing, there are a lot of options, and which India is also practicing for public, and that also transfers some of the risk from the government to the people, like crop insurance, life personal insurances, house insurance, livestock insurance, industrial insurances, and there are a lot of examples. I mean, uh, Pradhan Mantri Fasal Bima Yojana, weather-based crop insurance schemes, and Aam Aadmi Bima Yojana by many states, and I don't know whether there is a national such thing or not. And most of these things, I believe, are governed and driven by the government, and government invest in them. And my understanding is also that still, I mean, the penetration of these schemes is still very optimal, and not as required. The reasons are many, and I think one of the reasons is that they are not promoted well. Second is the risk is not still uh, explained to people in the way it could have been done. I mean, for example, if I do an insurance for my house, I'm not told in which risk region or the flood region I'm living. Second is, I mean, as different banks do such insurances, they have, I mean, they have their own risk maps. They have their own risk rating systems. They do not comply with the risk rating systems of the government. So I think that notion or that information is not available for us to decide on how much we should be insuring ourselves. Is not there. Third, I think in terms of Fasal Yojana and parametric things, the window which normally government provides for such schemes to uh, materialize, most of the time it's too small a window for people to get the insurance, and that is why they people are left out of such schemes. The incentives for agents are also too less for them to consider going for it, and that is why the penetration is not as required. So definitely, I think there are a lot of factors which require investment apart from investing in different tools, in terms of awareness, also in terms of policy change, also in terms of investment in different such things. And I think there is also a requirement of bringing in public players more, uh, so that I mean they also have their stake in risk retention and risk transfer. Uh, yeah, and I stop here, and thank you for the opportunity, and look forward to hear from others. Thank you.
Thank
Over
you.
to you, Anuradha.
Thank you, Mr. Deepak. I'm just looking if there are questions in the chat box, and one of the questions, if any of the panelists could address, would be that how can insurance and financial tools during disaster risk reduction be helpful or be useful at the micro level? And while this has been covered briefly in all the addresses, if someone could address it specifically, perhaps Mr. Deepak or Professor Jena, if you're there.
I can answer, and Professor Jena, I think he is a financial guru, so would love to hear from him rather than me. Thank you. Over to you, sir.
No. See, anyway, I thought I would be learning more from this discussion on how insurance would be very helpful. But my feeling is that in this country, we are still struggling with insurance. And and our experience with insurance at various levels is not very good, and given the kind of risk, the disaster risk that the country faces, and given the kind of institutional, given the kind of responsibility that various, suppose, state governments and central governments and various organizations have. And once again, it boils down the capacity of the state governments and capacity of the people there and the insurer and the insurance companies to recognize the potential for this kind of insurance at various levels, as discussed by Professor Malik and others, whether it is crop insurance, whether it is any other kind of and the infrastructure insurance assets and other things, and the kind of information lag that we have. This is, but what I believe, this is an emerging area. And if we look at the Fasal Bima Yojana of the central government and various kind of crop insurances the state governments have extended, the results are mixed. We do not have an unqualified success when it comes to this kind of insurances. Given the way the climate is behaving, when it comes to, given the looking at the experience of those kind of insurance schemes. But when it comes to insuring against disaster risk, this is a new thing, and I'm sure it will catch up. It will catch up, and the problem, as the person who asked the question, the problem will be at the micro level, where people who at the villages and smaller towns who face this risk, whether they will be able to actually manage through this whole insurance business. Thank you.
Thank you, Professor Pratap. Over to you, Mr. Deepak, if you would like to add to that.
I mean, in terms of the insurance, how it make difference, definitely, I think when we talk about, although as Professor Anjan has said, that I mean, we are getting mixed results. However, I feel that, I mean, it's a work in progression, and definitely it will increase its impact in terms of drought, whether it is or in terms of flood. The way in which weather is predicted now, I think we are getting accurate, much accurate than before in terms of parametric insurance, claims. People are more interested. So definitely, I think in terms of disaster, it has such parametric, investments are going to support people. And definitely, I think even the insurers with whom we work, they are also reinsuring themselves. So it is transferring the risk not only to the insurer but to different international entities. So definitely, I think it has an impact in terms of risk transfer of disasters to other entities. Thank you.
Thank you, Mr. Deepak. So I think what we can sort of, it would be safe to say that while India as a country has made a lot of progress in terms of the financial arrangements in DRR, there is also a scope of lot that we can do. Here, I would like to take the opportunity to sort of bring together what Professor Pratap, brought forward in his address, where he said that, the DM Act 2005 was very critical in institutionalizing the DM bodies that exist in India right now. And the 4 guiding principles on which the Finance Commission recommendation, 15 Finance Commission recommendations are based, which is recognizing the institutional structures of NDRF and SDRF, the mitigation fund, and the sharing principle, and the alternative sources of funding. I think it was very, very interesting to know about that. What was even more interesting was to know about the mitigation fund we have both at the national and the state level, and the allocation that has been made for capacities for risk on 3 instruments. I mean, earlier the allocations were based on expenditure, and it is heartening to know that now the allocations are based not only on that, but on capacity, risk exposure, and a risk index. However, the three demarcations that we have in both the NDRF and SDRF in terms of response and relief, recovery and reconstruction, and preparation and capacity building, it was interesting to know about that as well. However, there are alternative sources of funding that could be explored, which is that state government can issue reconstruction bonds, international financial institutions can be roped in, crowdfunding platform can be set up for disasters by the state government. It is a very interesting proposition. And the CSR window, which the humanitarian sector in itself has been exploring for a while now, and insurance, of course, being one of the biggest things. I think what is most critical, however, is to bring in the outcome approach, and which was quite, emphasized on also by the Public Finance Commission report. So with that, I think it is also important for me to conclude what Mr. Deepak said in terms of the various tools that we can bring it, whether it is weather derivatives, catastrophic drawdowns, contingent funding, and also a few more tools that don't exist in India right now, which are catastrophic insurances and pool and bond insurances. And while this has been quite a task to sort of bring together a lot of information in 2 minutes, I have tried my best to do that. But if I have missed out anything, I request the panelists or Dr. Anuradha to please add to that. And thank you, panelists, for addressing our questions as well. If there are no more inputs, then I'm going to hand this over to Shipra for her concluding vote of thanks. Thank you.
Shipra, you're muted. Shipra, you're not audible.
I think Shipra is facing an issue with the mic. Shipra, could you just say a hello and we'll just test this for one last time? No, Shipra, I'm sorry. I think we are facing a problem with your mic. Never mind. Dr. Anuradha, can I hand it over to you for the vote of address? Or thank you. Vote of thanks then.
Yes, for sure. So we've had a great session with two eminent speakers who've enlightened us with a lot of knowledge on financial arrangements that participants could get from. As a collective vote of thanks, I would like to thank all the program's patrons, Major General Manoj Kumar Bindal, who is the Executive Director of NITM, Professor Santosh Kumar, who's the faculty and who is the convener of the program. Our two distinguished panelists, Mr. Pratap Rana and Mr. Deepak. And further, I would also like to thank the coordinators of the program, Swear India. And thank you, Valeri, for organizing everything. Big thanks to you, though. And lastly, all the participants who could make it possible and were actively engaged in the program and participated in our webinar. So with that, I think we come to an end of the webinar, and thank you everyone. Stay safe, and one last information I would like to give you all is the participants can generate their certificates from our e-portal. The information was shared in the chat box by Shipra. And if you have any doubt or about the certificates, you can always contact NIDM for that. So thank you all.
Thanks, Dr. Radha. Somebody had been asking for the video link. We've pasted the video link in the chat box for the reference of the participants. And if you still face any problem, you can just go to YouTube and look for Sphere India and you will find the session there. Once again, thanks Dr. Anuradha, and thank you to all of the panelists and participants here. Thanks Shipra as well.
Yeah.
Take care.
Thank you. Thank you so much. Bye.